Let me welcome Gaurav Kochar, who is the fund manager equity at Mirai Asset Investment Managers. Hi, Gaurav. Very good afternoon, and thank you so much for your time. First of all, Gaurav, Nifty 50 is just a couple of 100 points away from its all-time high levels. And since we keep talking to the market experts, the consensus view is, given the run-up, they are a little uncomfortable with the valuations that Nifty is trading at. What are your views on this, Gaurav? Do you concur with it? As well as how do you see the benchmark indices moving ahead?
Sure. Very good afternoon to you, and thanks for having me here. So on the markets, if I look at global context, India do look expensive. But if I look at the long-term average, today if I talk about large caps, I split this conversation into three parts: large caps, mid caps, and then small caps. So in large caps, if you look at Nifty today, we are trading at 21 times 1 year forward. If I look at the long-term average, if I take last 15 years average, the average valuation is around 19 times. So we are about 10% expensive than long-term average, but the support is coming from the earnings growth. If you look at the next couple of years, the earnings forecast is around 16%, 15 to 16% on the Nifty. So there is a strong earnings support that is driving the multiples a little higher. And with that kind of earning growth, one could probably ascribe a slight premium to its long-term average. So to that extent, I think at least the large cap looks not so expensive. Coming to mid caps, mid caps are trading at 34 times 1 year forward. The mid cap index is trading at 34 times 1 year forward. And if I look at the 15-year average, is around 28x. Again, the earnings support is quite strong for next couple of years. The earnings growth is around 21%. Maybe that is the reason why you're seeing that the mid cap index it's a little frothy in terms of valuation. And if I look at the small cap index is trading at 25 times 1 year forward with an earning support of 19% over the next couple of years. And if I look at the long-term average for small cap index also, it is around 21 times. So only slightly more expensive than the long-term average. So I would agree that maybe in certain pockets there is market which is very expensive, but on a very broader level, you look at large caps especially. I think the markets are reasonable. I will not say they are overvalued. So yeah, from a 2 to 3 year perspective, as a house also we are more bullish on large caps from here on versus small and mid caps.
All right, Gaurav, got your take that the markets do look reasonable to you at this price point. But Gaurav, what are the spaces that are looking interesting to you? Any new area that you are eyeing at?
Sure. So, as a house, we are overweight financials. I think where valuations are quite reasonable. We are overweight in consumer discretionary, where we see a lot of potential for penetration, and we see a lot of earnings upgrade also in that space. We like building materials as a proxy to real estate, where I think the cycle is pretty good from a medium to longer term perspective. And we also are overweight pharma. I think the pricing discipline has been quite strong in pharma, and this is a space that we like. Incrementally from a 2 to 3 year standpoint. On the space where we think where we are underweight as a house, we think auto, industrials, and IT. These are the three broad sectors where we are kind of underweight. Industrials more so it's a valuation call, while the macros and the tailwinds on spending etc. is quite strong. There's a lot of focus on the government on manufacturing etc. But we like that in certain pockets. But on a broader level, if I look at the valuations today, I think it's a little punchy. So to that extent, we are underweight industrials. In IT, we are waiting for the turnaround, especially in US, and we hope that by the year end we will have some clarity on the rate cut cycle, and with more and more spends coming in from US corporates, I think IT should also pick up. So we're waiting for that cycle to turn. Till then, we are kind of underweight in IT.
All right, got your point, Gaurav. But since you were just touching upon the autos, I wanted to dig deep into that. Since what we are seeing, Gaurav, is a couple of concerns related to the higher inventory levels, specifically when it comes to the passenger vehicle segment. Even apart from that, it's like a single-digit growth guidance coming in from the companies for the tractors. Those CVs expected to perform decently well. Even from the two-wheeler segment, not much hopes from that, given that the run-up they are expected to, the growth they are expected to continue in this year itself. Gaurav, wanted to have your thoughts on the auto space. If one has to play, which area is looking interesting to you, or maybe for the next 2 to 3 years, how should one build on to their view with respect to this space?
Sure. So as I mentioned, as a house, we are underweight auto, and for the precise reason you mentioned that we heard a couple of corporates suggesting that they are cutting production or getting the production in line because they see some bit of inventory buildup happening at a dealer level. While you're right that the volume growth has been little soft or expected to be soft this year for passenger vehicles as well as tractors, I think there is some shift which is happening within the passenger vehicles, maybe a little more focused towards the high-end vehicles, SUVs, etc., versus entry vehicles. So that theme seems to be playing out in auto. So the value growth is still better. Having said that, again, the valuations do factor in some sort of growth that is happening in the sector. So to that extent, I think as a house, from a 2 to 3 year standpoint, we would continue to be a little underweight on auto. I think the valuations need to correct a bit for us to turn a little overweight. The other point we need to focus on is how the monsoon, till now the monsoon seems to be reasonably good. The reservoir levels are quite decent at a pan-India level. And maybe because we have a strong festive next couple of months. So we'll see how the demand picks up and whether this inventory gets cleared. So I think in next couple of months, we should know, where we are heading in terms of growth in auto.
All right, but Gaurav, I also wanted to understand any such risk that you are foreseeing coming in for the markets, or you are wary about. Why I ask is that since you are saying that the market up move is looking quite reasonable, but there are a lot of macro developments that are expected to happen not just in India but majorly on the global front. So, what's your take on that, Gaurav?
Yeah, sure. So I think the global risk is, I mean, the geopolitical risk is one that I can broadly think of. What's happening in the Middle East today, and we've already seen some supply chain disruptions because of Red Sea crisis. So prolonged conflict, could be a big risk here. The other risk is again the valuation itself is factoring in a lot of sort of execution to play out quite well. But we've seen in the past, the cycle is pretty long, and there could be intermittent patches or phases of some slowdown or some bit of economic sort of pull down, which could happen, and these valuations do not kind of factor in that. So that is also one of the risks we think because of both global as well as domestic risk that is there. There could be challenges like we saw what happened as I mentioned on the Red Sea in the Red Sea crisis, that there could be some near-term challenges that the market is not really factoring in today in terms of valuations. So these are the two risks that I think one should be wary of. And coming to your question on global macros, I think interest rate is one metric that we are grappling our heads with is what's going to happen in the US. Today, if I look at, different central banks have taken different opinions or different sort of calls. Bank of Japan has raised rates, the ECB has cut rates, while US is status quo. The Fed is expected to, reduce rates in the coming policy meet. So we'll have to see how that pans out, and that would probably shape up how the Indian interest rate cycle will also behave incrementally. And as far as RBI is concerned, I think from whatever we've heard, the governor has spoken about moderating inflation as the key sort of outlook from RBI perspective. And only once the inflation is in that tolerance band of RBI will they think about cutting down rates. So I believe it could be a little more gradual than what we're expecting. Maybe one rate cut in this financial year is something that we can look at in the base case, assuming a 50 to 75 basis point kind of rate cut happening in the US in this financial year.
Right, and also Gaurav, share your view on the financial space on an overall basis. Why I asked you, and specifically wanted your take on the microfinance lenders, because it's coming in from the top players that they are having some bit of a difficulty in garner the deposits. Other than that, that's the credit cost that is hampering their growth. So, what's your take from the top notch to the bottom, in the bottom player in the pyramid? Where do you see the way for the value growth, and what's your take on the overall financial space as well?
Sure. So I'll talk about the microfinance part. It's a very important point that you touched upon. I think of the last 3 to 6 months or so, we are seeing some bit of over leveraging building up in the system, and RBI has been talking about it. The you know the various institutions are talking about it now, that there is some bit of over leveraging that is happening in the system. But the good part about microfinance is that once the discipline comes back in and all the lenders adhere to it, it's a very short-term problem which gets resolved in normally 2 to 3 quarters. So we expect that now that the resolutions have been passed in most of the governing bodies of the RBI, which is MFIN, Sadhan, etc. They have taken efforts to get the lenders on board in as far as the overall discipline is concerned. I think that should aid well for the sector from a medium term perspective. I think the microfinance is a very mature sector now. I think it's been over 15 years. So I think the sector should bounce back in 2 to 3 quarters. Coming to your question on the overall bank deposit growth and credit growth, I think a lot of discussion is happening around this. RBI has been highlighting this. The FM has highlighted this in a couple of interactions. I think the point here is the credit growth has been benign. You look at the sector growing at 15% kind of headline credit growth, while the deposit growth has been 9 to 10% only. I think that is what is concerning most of the bankers and even the RBI. So I think the idea is that the excess liquidity which got built up during COVID and when the rates cut happened is now getting sucked out of the system, and we are seeing some bit of liquidity deficit on certain days. So that is something that RBI do not like. I think RBI would like to build a little more liquidity buffer, and as a result, they would want the credit growth to come down a bit, moderate a bit, and deposit growth to pick up a bit. I believe in the next 3 to 6 months, we should see both the credit growth and deposit growth kind of converge, because the CD ratio, which is the credit to deposit ratio that we track, is at around 78-79% at a system level, and this is where precisely where the CD ratio typically peaks out. So I think from here on, if I look at YTD, ignoring the YOY data, YTD from December 23, the deposit growth and credit growth are broadly matched. So we believe that once the base is out, probably by March of this March end of this year, which is the end of financial year, both the credit growth and deposit growth should converge to more like 13%.
Right, we look forward to that. But with this, Gaurav would like to thank you for taking the time out and joining us today in this discussion, and especially sharing your interesting view on the financial space as well. Pleasure having you.
If you like this video, then like, share and subscribe to ET Now.